Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, before we get into the show, just some quick housekeeping notes here. We're conducting an audience survey of the Forward Guidance audience, and we're just trying to gather feedback on what are some of your favorite parts of the show, what could you see improved, and what's your general vibe of things so that we can try and improve it. So the link to the survey is in the show notes. So if you could fill it out, that would really help us with improving the show for you as we move forward into the year. Thanks, everybody, and back to the show. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. And this week we got a little swap out action here. Tyler was busy and couldn't make it this week, so we pulled in our Anon Pepe friend, Capital Flows, Global Flows. What's going on, man? Great to have you on the show again. The last time you were on here was an absolute banger, so I'm sure this will be fun.
I know this will be cool. So I'm glad to be here.
I'm still getting in this Thursday routine. Tyler really threw us off with it, and then he ditches. He says, "Hey guys, can we move this to Thursdays?" And then he ditches us.
Yeah. Dad things. Who knows? Yeah, we're recording now these days at just on market close on Thursday, so a little switch up there. But yeah. Okay, guys. So obviously, there's a lot going on in markets right now, and a lot of it has to do with we're week one into the Trump presidency, and there's a lot of expectation built up into everything that was going to occur, and now the rubber is starting to meet the road. We're starting to get these executive orders. Just in the last half hour, we just got like a spam of new executive orders and headlines, and lots to talk about. But the first thing I want to talk about, which is relevant to us in the macro world, is effectively what Trump is talking about in terms of, he's hinted at this in his campaign, but now we're starting to see it become kind of real, which is Trump says he expects the Fed to listen to him on interest rates. That really sums it up. He wants interest rates lower. He feels like he can pressure Powell and get what he wants. And the market is going to need to digest this. So I want to open it up, and maybe we'll start with the guest of the week here. Capos, would love your take on how are you thinking about how you're thinking about it, and also how markets are thinking about this situation.
Yeah, so this is really interesting because in December, one of the things that I was talking about, and I think we even talked about on the podcast, or maybe we talked offline, I forget which one it was. We just kind of went over how Powell kind of like flipped the script a little bit. They revised up PCE. They did all these other little things in like PCE, and his conversation specifically when he came out at the press conference pushed down markets, right? And so that, was interesting because we just had all of these cuts that, brought the, Fed funds down, but then it pushed the 10-year up, right? And we had bear steepening and things like that. But I think part of Powell's strategy was, he's coming off a little bit hawkish in December, even though inflation hasn't really, blown out or anything like that. And, you have now this like massive tension because Powell clearly has, the whole, like legacy thing or whatever you want to attribute it to, like how he wants to be viewed and what he wants to do. And it's clear that, last press conference, him and Trump are not on good footing, right? Where just when he was asked questions directly about that, and he was just like, no, and he was kind of like pissed off. So like the fact that you have that, and we haven't heard from Powell since then, obviously, and then, or maybe we had something, but nothing significant. And then, you have, Trump didn't really talk about interest rates at all, and now he's just trying to come out strong on that. And the market's not pricing that, right? Like that news that Trump came out with today, like 2-year didn't really move at all, right? We're still pricing about 38, 39 basis points of cuts for the entire year. So in my view, you're going to have, you have all this pro-business stuff, obviously, and deregulation that's coming, which you would think if that, let's just say that is a net positive for the economy and it really pushes things up, you would want to have higher interest rates if you come in and you're like doing all this stuff. But then if you lower interest rates and you kind of like push all of this stuff out, it would seem like a massive melt up scenario where you have inflation almost certainly reaccelerate. So it's a very interesting kind of setup.
Quinn, what's your thoughts on the current tension between the executive orders we've seen so far and what was expected?
I'm sympathetic to the view that the fact that we went from an administration that is vehemently opposed to digital assets to one that is vehemently for digital assets is like phenomenally bullish. But I guess where I kind of am right now is that's why I was like giga bulled up in September, October, and November. And like the question you have to ask yourself is, has that thesis played out, or is it still in front of us? And there's definitely things still in front of us, but their timing is important and positioning is important. And to me, reading through that executive order, there's one, it's a stupid idea to have a reserve for non-Bitcoin assets. And it might even be a stupid idea to have a reserve for Bitcoin. And two, I don't know if anybody read it in there, is within 180 days is when the Digital Asset Committee is going to put forth a proposal for whatever they want to do. And then that's got to get through Congress stuff. And we're talking July. So that's just, the market was ahead of its skis, I think. So yeah, on that front, I'm not like bearish. I just think a little ahead of its skis doesn't mean things have to crater, but like clearly people were expecting really good news. That's all I read on Twitter. On the other stuff, like it was only a matter of time before Trump started talking about the Powell situation, and whether it's Powell or anybody else, he would be doing the same thing. So there's probably a little too much read into like this like feud, because it doesn't matter who'd be put in there, and whoever he puts in there is going to want to be independent and like uphold that picture. And Besant's in the background kind of massaging it, and they'll have their Wednesday breakfast tradition like Yellen did. And frankly, they have to work together. Like to given all of the things with the ATI, the Treasury issuance skewed towards bills, first duration, the RP drained, and all these things, the debt ceiling, they're going to have to work together, like maintain independence, and the Fed needs to do what they need to do if inflation gets out of hand. But yeah, so I don't know. It's a weird point. We have the BOJ tomorrow, which all else equal, we'll see. They're hiking rates, so maybe that's priced in. But people look to see what they're going to say for future. And then FOMC next week, I think, is huge, because the market's completely almost forgotten about. I would say the market's so high off the Trump optimism that there's not really so much care about the Fed's hawkish stance from December, which I lean towards, them not cutting in March if this data continues. That to me is too quick of a. I mean, December was a hard pivot towards the hawkish side, like almost like a there will be pain speech, and that usually doesn't get reversed so quickly. But on the other hand, small business optimism zooming up and staying up. You do have a lot of pro-growth, pro-business, pro-regulation components of a Trump presidency that, again, not just for crypto, but broadly speaking, lowering energy prices and letting drill baby drill is bullish because it brings inflation down. But it's a timing thing, right? There's still a lot to be sorted out.
Yeah, the big thing for me is definitely the timing aspect, and just comparing like what's priced into the expectations. So it's actually quite interesting. Like we saw a new high on SPY yesterday, but before that, we've seen this like weird month, in the lead up of the Trump inauguration, where there's quite a bit of volatility, and it's somewhat resolved itself, and we started to see this grind higher. And then you compare what's been going on in the crypto world, where it feels like there's a lot more headline risk, because so much of the price action, I feel like, has been dependent on these major positive news. So, when I see this executive order of crypto come in for some sort of strategic digital asset power, whatever hell you want to call it, and to see it sell off significantly like it is, as we record this right now, there's some alarm bells going there, but it's not, cyclical or even secular alarm bells, right? It's just like a positioning, being stretched type of thing. Capital, you've been short SPY, or you just started. So what are you thinking on that side of things?
Yeah, I mean, we'll see how it plays out. It's gone against me like half this week for sure, but I've been running some shorts, but the main idea is that, I think about the progression in terms of we have, growth in 2023, above expectations, very strong, and we had higher rates. And then 2024, you've brought rates down, and on the short end, but the longer end has remained elevated. And growth is lower in 2024 than it was 2023, right? And now we're going into 2025, and these higher rates seem to really be beginning to get transmitted a lot more through growth because you have the unemployment rate ticking up, you have some other things in terms of like cyclical weakness. And the main thing that has pushed the index up has been, Mag 7 performance, right? In over the past, I would say, month and a half. And you have the Russell still below. I still believe it's below the kind of hedging pressure level from the election in the beginning of November. So you have like a combination of things where these higher rates could begin to transmit into growth over the next, let's say, 3 to 4 months or something like that. And if you have those kind of putting downward pressure on growth, and then you also have this inflation that's basically flat, where you're probably not going to get a bunch of rate cuts. You're not going to get one in February because we'll have a meeting, and then March is unlikely. And, maybe we get, one more sometime this year, or maybe two at the end of this year or something like that if we get a growth scare. So, I think you have, valuations at these levels at the same time. Liquidity is contracting a little bit. And I just wouldn't be surprised if you have kind of I just see with valuations at these levels and liquidity kind of turning down a little bit, unless Powell really flips at the next FOMC, then it's kind of like if you get a growth scare, like expectations are pretty high for that. If you have inflation reaccelerate, that's going to pull on valuations, right? I wouldn't say that if we're a little bit lower, but we're basically at the same level we were at the end of 2021, right? So now it's kind of just, in my view, you have this just kind of positioning game where, okay, what is going to, feed through? And one of the things that has, if you're able to bring up one of the tear sheets for the FX side,
yeah, 100%.
What we've had take place is, equities move to all-time highs, bonds are still at lows, right? So you have rich equities, and then, I think bonds are pretty reasonably priced, but you have, that risk-free rate really high for like the 10-year, and then you have credit spreads really low. And that's taking place at the same time FX vol is rising. So in like the FX tear sheet, you kind of see that, Euro USD, the pound, the yen, all of these majors, if you kind of go to the bottom left-hand side of that sheet, you kind of see in the blue right there, Euro USD, that vol has been, pushing up, and over the past, let's say like 4 months, and it's higher. And, the VIX and the MOVE index have been lower, right? So you have some, vol being priced in like the whole FX side, and then now you have the dollar pushing up. So you have, rates pushing up a little bit or at these elevated levels. And I think I wouldn't be long bonds here, right? So I think you can have some pressure from rates pushing up a little bit higher or something like that. It's not, I don't want to buy yet, but I'm not really interested in shorting bonds. And then at the same time, you have the dollar pushing up as liquidity is kind of contracting a little bit. So those are kind of just some warning signals for the equity side, because it'd be less of a big deal if valuations were lower, but the higher valuations get, the more sensitivity you have to just that liquidity component. So that's kind of what I'm thinking about. To be fair, like we've kind of, moved against that view this week. And I think, the FOMC meeting next week is basically going to kind of tell me if I'm wrong or not on that view.
Yeah. So it's mostly a positioning thing, but like the cyclical view is still somewhat dependent on, like what do we see in the growth story? What do we see from the Fed next week, et cetera?
Yeah, because I think the positioning thing is going to be for the Fed, and like if that unwinds enough, because on the Substack, I was short vol going into CPI and then coming out of CPI, right? So like caught some of that, but then basically flipped, because in my view, I thought you have all of this inauguration and all this stuff kind of like priced. Yeah, I think you even saw that in Bitcoin, because I've been running some shorts in Bitcoin too, just for some normalization. But you have, all of these spikes that we've seen up on all this quote unquote positive news, they just get sold super hard and they just get faded. So, it's more of a positioning play. I'm not getting bearish on like a cyclical basis and saying, hey, this is the top and, we're about to, move down 50% or anything like that. But I just think there's like some warning signals.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at skale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show.
We kind of went back and forth in DMs about this coin, but what are your thoughts on that thesis?
I'm sympathetic to it. I've been cautious here too. I was cautious entering the year and was long energy and short Qs, and then closed that, started buying and caught a good amount of the move back, and then got cautious again. I think I think patience is going to pay off a lot this year. The liquidity picture concerns I have as well, but one thing I just continuously repeat to myself is inflation is only a problem for risk assets if the Fed chooses to do something about it, and central banks globally. So if inflation's back to not falling or rising, or 2020 was inflation was a problem, and it's less of a problem now, but it's, I would say, still elevated. But yeah, the market's clearly not believing the Fed's rhetoric from December, because I don't think the data's been that great since. And whether or not the Wallers of the world and others who have maybe come out and walked back some of the tone, maybe that's why. But yeah, I'm not chasing like the index. At the index level, I do think the outlook is just less attractive on the back of the best two performing years since 1928. But that's not to say that on a stock specific or individual sector basis, there's interesting opportunities. So it's requiring more work, and it's not as easy, I don't think, as the last 2 years were, but lots of opportunity, I think, going to be out there. And dispersion to me is just the name of the game right now. Like we're seeing these days, like yesterday, where the NASDAQ was up massively and small caps were red. And, in the crypto world, it's Bitcoin up and everything else down. So you just gotta, pick your spots where you have a strong idiosyncratic thesis, I think, if you're going to play.
There's an interesting thing you said in there about how, inflation's only bad for risk assets if the Fed responds. Otherwise, it's like probably quite bullish. It's positive for earnings. Like we've seen a great earnings season so far.
It's fiat debasement in real time. I mean, it's what everybody talks about, and the reason it's a slow moving, it's a melting ice cube, and you will never, ever, ever see a government or central bank official come out and say 3% is the new target or 4% is the new target, right? So they're going to do this dance, and
just through their actions, generally speaking.
Yeah, exactly.
Okay, so I want to elevate the conversation a little like bigger picture and have a chat about inflation. I know in our DMs, Quinn, you're saying I'm getting less and less worried about inflation in terms of reacceleration. Even stickiness, I'm starting to get less worried about. A big thing is, and this is actually, for those that listened to my interview with Warren Pies last week, it was a pretty large emphasis on this when we started talking about CPI inflation and just how much of it is the residual of the imputed prices and shelter inflation of just how they calculate owner's equivalent rent. And if you go and swap out, this lag nature of OER with something more real time, which is what the Cleveland Fed has been working on over the last little while here, is they have this more real time shelter inflation index, and you can actually see the new tenant versus all tenant index, and it's a pretty good leading indicator of where shelter inflation is headed. Now, important to say is that you look at this chart and you see this print came out yesterday and it was just absolute nosedive, and you think, okay, shelter inflation is going to be cratering, and that means core CPI is going to be cratering, which means the 2% target is within reach. But it should be noted that this print is also very much prone to revisions. So even though that print looks very significant in what it could imply for where shelter inflation goes, and therefore, in my opinion, where core CPI goes, you do have to take it with somewhat of a grain of salt that it is, prone to some substantial revisions. But I want to just set the stage that, like, my perspective on CPI right now is, when you just go through the biggest drivers, it's like, okay, shelter is the largest portion of CPI right now. It's the largest residual. It's an imputed lagged price. It's, if you do the analysis, which, like, Warren did pretty deep on that show, you can go there if you want to see it more quantitatively. But effectively, by March, we should see new rents catch up, and we should see a further decline in disinflation in shelter. So, okay, that's one component. That's the residual. As we saw in this recent CPI print, one of the largest positive drivers was gasoline, and so the headline print was up, whereas we saw core CPI was down, which is kind of the opposite of what we've been dealing with for the last while. So oil's up, yes. So then you have to have a view on global commodities. Global commodities basically effectively means you need to have a view on what China's going to do. So if China remains in the dumps at the same time that, you got the drill baby drill energy policy coming from Trump's side of things, even though there's very strong growth, I feel like that keeps a cap on oil at the very least. So what do you have left? You have core goods that look like, we're starting to see potentially like a rebound in the manufacturing sector. So, you could see some further inflation from there. It depends on your view on where we are in the business cycle. But, that is, you got to weigh that against what you're seeing on the shelter and the services side of things, which is looking like it's going to continue to accelerate downwards. So putting that all together, to me, I feel like, it's an exaggeration to go from, the Fed SEP going from 2.1 to 2.5 core PCE last month. That feels like an exaggeration to me. What's your guys' inflation framework? So for me, that leads me to feel like in 12 months, like we're not going to be worried about any form of acceleration.
Yeah. The other one I don't think you mentioned, but is labor, which is kind of also showing signs. It's sticky, but a lot of divergences in like large versus small businesses. And I would say, generally speaking, the forward-looking indicators don't show a very, high inflationary issue there, or at least a reacceleration there. So, yeah, I think that's why markets are pretty sanguine right now, because, the prints weren't great, like in terms of showing like huge corrections in inflation, but I think you have to take the Fed at their word a little bit, which is they still believe they're restrictive, and they also believe inflation is sticky and it's not finished. I think they're kind of speaking the truth. It's not finished to their 2% target, and if it stays at this level, then they maybe are a bit restrictive. I would say I would expect there to be cuts this year, at least some amount, because of if Besson is going to reverse some of the issues he had with Yellen's policy of conducting treasury issuance, and that means more supply for the long end. I think you should still continue to see a steepening, both from long end yields, either flattish to higher if growth is fine, and front end lower over time.
Two things on the big picture side. There's this tweet from an account that has since been deleted, but it's basically this guy that was sharing a bunch of different kind of like trading wisdom and stuff like that. And he said, my mentor used to say to me, say that we should find the one idea that has the world in its grip and trade the markets in the opposite direction. And that was kind of one of the things that he, talked about, whether it's like, oh, everyone thinks there's high valuations, or it's the end of the world, or central banks are doing this or that. Just kind of find that idea and like figure out how you can take the other side of it. And I think to me right now, that's not inflation, right? Like it's, in my view, the entire market and every news outlet, and you can even kind of quantify this a little bit in factor and sector flows, is completely focused on Trump as the new president and all of the policies that he's going to push out. And in my view, extrapolating it as the single variable that's most important for kind of this roaring 20s move. I don't know if that's true or not. I have no clue. I just know that like all the people I usually like take the other side of, they're all saying that right now. And so I just kind of use it I just have a little bit of caution, because I know in my view that the inflation side of things is directly connected to that. We basically have, services is still moving down. A lot of the core components are moving down. Goods have some volatility right now that are ticking back up. And then we had energy prices rip over the past, since middle of December to January. And then I was actually messaging, I think I was messaging Quinn like the top tick day or something like that. We were going back and forth because I feel like that's when you got out of you were switching some stuff. But I think that a lot of it is going to come down to how much of all of this is going to get realized. And in my mind, it just seems like if I can find asymmetry in certain sectors, whatever else it might be, I want to just take the other side of it in things that are just kind of over extrapolating this pricing for kind of the Trump side of everything. So that's why you need a macro catalyst to shake that positioning. So this entire week has been like, it kind of feels like inauguration flows. And then next week, are we going to have Powell shock the market? Because they know right now, like if all of these Trump policies go through and they start really like pushing that, we're going to go into 2021 era again, where you have where they're holding the rates on the short end constant. And you even saw like today, like curve is bear steepening, right? Rates on the long end are moving up, 2 years not moving at all, right? And if you have that move into like FOMC, right, and Powell just sees markets ripping and all that stuff like that, like with the valuation levels that we're at right now, like that's going to start feeding into the economy. So yeah, that's kind of the tension that I'm kind of thinking in right now.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at skale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. I think one thing that's really interesting, I haven't seen too much talk about yet for this next upcoming meeting, is obviously we're in the new year now, so you get the rotation of the voting members of the FOMC, and we've had, I might be wrong on this, but I believe it's 3 net dovish members in, and then, or I forget the number, but there's more net dovish members on the FOMC. For example, the most dovish of doves, Austin Goolsbee, who thinks we're significantly restrictive now, he's voting this year, and he got swapped out. He swapped out for Beth Hammock, who was the one who who contended and voted against the cut last time. So that just goes to show that there is, it's something that's always important to keep in mind in the new year, is that the voting distribution changes into the new year. So now we're going into this next FOMC meeting with a dovish tilt in the composition of FOMC members. And I think that doesn't really get talked enough, is that actually does regularly change. Okay, so I actually, Kapil, you mentioned something in there about the curve, and this has quickly become like my favorite chart in the world that you make. I'm a big fan of it. So you're talking about this idea of like the curve.
Gives me a seizure.
Oh, come on, man. This is so cool.
This is fucking awesome. Okay, so this is an interactive version that you sent over a bit, and I'll just like zoom in on,
Yeah, if any of the listeners want this, I send it out every day in the tear sheets, and then if you want this specific model, I'll link all of these things in kind of like an article. I'll send it to you guys.
Nice, love that. So yeah, this is really great because obviously when you look at the twos tens, it's hard to know which side of the curve is moving in which direction to understand the flows, because a bull steepener is very different from a bear steepener. So this is providing you color coded context of what's been going on, and you can see like this big run up in the term premium scare, whatever you want to call it. That orange part has been this big bear steepener, and now it's come off a little bit, but it's starting to re-steepen. So yeah, Capital, do you want to just break down like how are you using this? What are you thinking about it in terms of the recent action of the past couple weeks?
Yeah, so the way I think about the curve right now is, and maybe you can scroll down to the dates so everyone sees or have the dates in the frame a little bit, or maybe zoom out a little. But basically, that blue section where we uninverted, that was bull steepening. And what that means is the 2-year and the 10-year interest rates are moving down at the same time and causing the curve to steepen. And a lot of people, during that time said, oh, when the curve uninverts, first it was, when the curve inverts, that's a signal for a recession. Then it was, well, let's switch that because that's not working. And well, let's say it's when the curve uninverts, that's when a recession is. And that happened. And we had, that bull steepening, and we had a whole Goldilocks scenario all in 2024. And then since then, we are just in this range where we're basically flipping back and forth between, okay, we're cutting a little bit, but we have some inflation risk. We're cutting a little bit. And then all of the back end of 2025, we, bear steepened where, 10-year nominal rates began to move up much faster than the short end, which basically means that long-term nominal GDP expectations are rising and the Fed is not, shifting dynamically enough to that. If you can kind of say it on that side, or the short end is not pricing it as aggressively because we basically see like the Fed, pausing. So that's what has happened, where we've had rates on the long end price a little bit more risk of, duration risk for nominal GDP being a little bit higher, and that has taken place as the Fed has paused, right? So anytime the Fed takes action or pauses, their action is an input into long-term nominal GDP, and the curve is the spread that reflects their action or inaction, or the economy's response to their action or inaction. So where we are now is we've flattened a little bit from the highs, and now this has like a 20 look back on it, I think, for the end period. But today specifically, we bottomed a little bit, and we're still in this period where it's steepen or twist a little bit, where the 10-year rate is moving up and the 2-year rate is kind of flat, kind of up just a little bit. It's not making a ton of moves, but it's still kind of like a bear steepening where the longer end rates are the things that are moving up. And the Fed is not. That's why I think the whole tension between Powell and new Treasury Secretary is going to be interesting, because if they don't want to, I mean, I know they always play ball, but what happens if they don't want to play ball, right? What happens if Bessent is clearly on Trump's side and doing what he wants, and they say, hey, we have to do this or that for duration issuance versus bills, and Powell says, well, no, I don't want to do that. Like, what's going to happen to the curve, and what's going to happen to short rates and all that stuff? So in my mind, when you have the dollar moving up and then you have this bear steepening at the same time, that contracts liquidity. Like fundamentally, that's contracting liquidity because there's too much kind of duration risk in the system. So, that's one of the things, like, the fact that we are seeing that happen today, and then equities still pushed up and closed green, kind of just gives me a little bit of caution, in saying how much is that positioning and how much of that is the macro impulse behind things. And that goes back to, are we really seeing this step up change where, we just had 2 years of over 25% year-to-date returns, and now equities are at, like these valuations. Is the Trump economy going to produce a significant amount of growth without inflation? If that's true, if it produces a massive amount of growth without inflation, then sure, you can have another year of 20% or something like that. But it just doesn't seem like that would be a great bet to take.
Yeah, it's funny because I've been in the position like bullish Trump and that his admin's really good for the economy and crypto. And then we are at this point where that's more priced in, but also like it might not be enough priced in if the data keeps surprising, so it's this thing where you need to keep updating your views as the information comes in, because I do believe that this Trump bump there's real good reason for it in terms of who's in his cabinet, who's gunning the treasury, seats of power. Like it's just objectively good for the stock market if the SEC is handcuffed, right? I mean, like generally speaking, or at least parts of the market. I don't know. Maybe at least in the short term, maybe not long term. If there's things that are done that erode investor confidence, but so I'm kind of waiting for a fat pitch because I see reasons that could create a bullish environment. I also noticed that it seems to me that everybody's biggest risk for 25, although like the sentiment is so optimistic for Trump, I almost feel that everybody's risk for 2025 is growth. At least a lot of the like macro like commentators and strategists that I follow. And I don't know. I don't have enough signal right now. But I do kind of, my gut wants me to kind of trust this move, especially looking back at his previous presidency in 2017. He's clearly on a different strategy with regard to tariffs, which kind of made 2018 pretty choppy. So yeah, like I just think there's not really a catalyst either way, and so like there's not a hugely bearish catalyst and not a hugely bullish immediate catalyst aside. Well, the closest Trump bump is the closest thing to it, so I think the market's going to ride with that until given reason to believe otherwise.
Yeah, to your point about like just waiting for a fat pitch, I feel like that's definitely resonating with me. It just sort of feels like we're in the macro doldrums where everybody wants like the economy to do the thing it's going to do really quickly, and then we all get excited and go buy TLT calls and that sort of thing for the growth scare or whatever. And yeah, like we talked about last week, like these things take time to play out. So I feel like personally, like last week I made the pitch that we're entering a new business cycle, and if you look at the optimism index and how that's moving into PMIs, it's looking like we're in a new business cycle. But then I wake up the next day and then I think, oh shit, like look at growth. So it's a time of what I feel like is a lack of conviction for a fat pitch.
For me, a recession is not going to come if deficits are still where they're at. So to me, I can't get bearish the economy until unless something needs to happen. Either the deficits spending goes away and there's real meat behind the Doge push and a balanced budget, or that continues and then the supply issue causes a real rate scare. Doesn't need to be an inflation scare, frankly, but it would likely be triggered by one. And until then, we're just kind of in this middle ground, like we're in the middle of the range, and we know that equities like to go up over time. And you have like a pumper in chief with Trump at the helm, who judges his presidency's success by Bitcoin and S&P 500 prices. So it's a tough thing to fade without more specific catalyst. And I'm really, really curious to see the Fed meeting next week and see the tone and shift. Like maybe Bessent has done enough, friend making with Powell in the last couple of weeks that Powell will change his tune completely. Maybe Powell is still scared of inflation and comes out and tries to reinforce his December message. It's really tough to say.
Yeah, I'm actually trying to pull a chart from Bloomberg right now and throw it in the deck. I know it's kind of last minute, but here's what I think about, like when I saw this chart and some others, is I see a chart like this and we see 2022 and then also 2023. Like everyone's talking about, we had growth positive. Everyone's talking about like layoffs or what do they do, this or that, whatever that might be, right? Across all these different sectors. And those usually occur during recessions. And it's it's just interesting to me because I think so much of like all publicly traded companies are getting so much better at managing, in a sense, their cycle risk, right? Like they're just kind of, they're all tuned in, they're all reading the news, they're all watching interest rates, they all have like, they're all on Twitter, right? Like everyone's watching this stuff, right? And I almost think that, there's a different kind of time frame set up where you typically have all of these different. This is actually a conversation I had with a guy that I did a podcast with, Josh Schultz, the other day on my thing. But we basically talked about how like COVID, when it shut everything down, it recalibrated like all the contracts in the economy to like the same time, right? Because typically you have all these different contracts where it's like, hey, I'll do this. It's 5 years out. I'll do this. 3 years out. I'll do like all these different things on different time frames, and I sign different contracts that roll over. Like that's the whole thing of like owner equivalent rent, right? Like it has a lag, and the logic behind that is that you're like accounting for, yes, you're charging, let's say $2,000 for someone's rent, but that doesn't roll over for a year, right? So even if the rent goes down tomorrow, you're still locked into that rate, which is a quote unquote higher inflation rate for you. So you've had that take place across. You've had, COVID kind of reset all of the different contracts in a sense in the entire economy for the US and even in the globe. So it seems to me, that those different timing of the contracts allow some like offsetting of different risks and timeframes and pricing pressures and stuff like that. And since we reopened, everyone is kind of on this like a similar time contract now. And so it seems to me that like the only thing that you can do to break that is to have a recession. And it seems to me that no one is talking about, I don't think anyone thinks a recession is going to happen this year. I think that's kind of out of everyone's brain. Inflation, I don't know. I mean, it seems like it's going to be, unless Powell really flips next week, it seems like it's going to be tough, right? Which is why I kind of come back to this thing of like, no one is looking or pricing a recession or anything like that, which, whether that is an input into it happening or not is kind of up for debate. And then everyone is just looking at this Trump side of things. And then every single CEO on the economic slowdown side, like every single thing that they're saying, and we're going to see, like all the earnings come out, soon anyway. But they're everyone is kind of gotten back down to the kind of this cycle lows where like credit spreads are, right? Like all of their comments are just following credit spreads. So, make with that if you want. It seems like it's a time to kind of take a second before taking a fat pitch and just waiting. I like what Quinn said.
Yeah. This is such an interesting chart to go with what I just kind of talked about, the potential of starting into a new cycle. Like when you start to look at this increase in 2022, like, of course, this was the time where we saw 2 quarters of negative GDP growth. Obviously, one of those got revised back to positive, and a large driver of it was just net exports. Like consumption was still strong. So you can, and the labor market was still, just absolutely cooking. But when you look at certain sectors, it did look like we might have gone through a bit of some sort of recession, perhaps, and if you look at through the right lenses. But then it was perhaps papered over by the huge fiscal deficits we were running. And perhaps now we're getting to a time like to what I was talking about how PMIs are starting to look like they're going to take off. Like the manufacturing sector is looking like it's going to start to come back to life here. It's starting to look like that was it in 2022. And now we're in this bit of a reset, and it's sort of just trying to temper about where we're at within it.
Yeah, I will. Sorry, I was going to say, Quinn, on the view that you were sharing, the idea that like, okay, I'm going to wait till like deficits reset, in my mind, that's not like, even like when I look at it historically, like I feel like deficits are always expanding, like as you move into recession and as you're in a recession, right? So I guess it's more about, I think, the counter cyclical spending. I think, I don't know if deficits come off, like I don't know if they're going to, right? I think it's going to be, I think they'll remain constant. And if we begin moving into a recession and we have unemployment tick up and things like that, like it seems to me that they would only rise. I guess I'm not using that as much as an indicator for when I should get bearish on a recession, because I don't know how much that's going to and then even in terms of like the deficit, right? Like how much of that is like, we had the quote unquote fiscal cliff in 2022. And even then, we had that negative, and then we had cyclical sectors a little negative, but still didn't have it. So I guess, I don't know, how would you think about that, or that kind of the other side of that argument?
If the Fed is monetizing the debt issuance, then I don't think it matters that, like I'm agreeing with you. But when in 2023, you had two monster cases of this in March, banking crisis, when the Fed stepped in a big way and they backstopped all FDIC banks from a treasury perspective. And then October 23, when they did the first or maybe second gross kind of pretty obvious treasury issuance manipulation to reduce duration. And then last year we had that continue and 100 basis points of cuts. So I think my series of events is deficits continue, long end eventually goes higher, eventually long end becomes a problem. If inflation is okay, the Fed will monetize. If inflation is not okay, they won't. And then you have a interest rate problem that slows down the economy and looks more like 2022. So yeah, I think we always want, like you said, Felix, we always want something to happen. But 2017 was similar, with Trump's first year, and it was the lowest fall year ever. After January, everyone was tweaked. And you look at other periods like the 90s, or there's years that go by, and I would say there's a difference, which we're not used to it, but there's a difference between the economy and financial market and financial asset stock valuations. So you could have a situation where the economy is fine, but the S&P finishes the year at the same price as 6,100, just because there's a lower expected growth out beyond 2025 that gets sort of priced in or digested. But we just do that. Like, there's a scenario in my head where, and it's kind of like probably my base case, where it's like this year for and equity indices is like the Bitcoin or gold just chop range. Like, maybe there's a slight drift higher, but it's hard to make the case for like a Zoomer plus 25% year, given us the starting point. And it's hard to bake in multiple expansion at this point. But again, like, this is the time, in my opinion, and we'll see, I guess, but where individual stock selection and sector specific moves will stand out, and that dispersion kind of continues. But like, even within Meg 7, right? Like, Apple is getting smoked.
Totally.
Probably because they wouldn't replace my headphones a year and a day after the warranty, or one day after the warranty ended. They wouldn't. So that's why it's repercussions for that.
Yeah.
But, and then you had NVIDIA, which is zooming. So like, you're getting just dispersion everywhere.
Yeah, well said. Well, we're running out of time there, guys. Want to be respectful of that. But Capo, it's great to get you on. Thanks again for sharing those tear sheets and that curve. Yeah, we'll throw a link in there for those, because they're super useful. I appreciate it a lot. And
awesome. Thanks, guys. I appreciate it. It was cool chatting.
As always. Sweet. Yeah, we'll have a good weekend, and we'll see y'all later.
All right. Later.
Peace.